Hello, in this video we'll talk about group term life insurance and we'll specifically look at the rules going through a problem. The Crazy Coconut Corporation carries group term life insurance on each executive and many of its employees an amount equal to 2 times the annual salary of the employee. Each employee gets to designate his or her beneficiary on if there is a death and the insurance proceeds get paid out. So it doesn't go to the employer, it goes to a beneficiary that the employee designates. And the premium cost is $12 per year per $1,000 of coverage. Now we're going to look at one specific executive, President Papaya. President Papaya is covered by the company and has a salary of $200,000. So the question is, what are the tax consequences with respect to the item? So remember, whenever we're dealing with income tax consequences, we have 5 questions that we need to look at. The first question is, what amount of income, if any? The next question is, what amount of deduction or credit, if any? So we're dealing with inflows in question 1 and outflows in question 2. The third question is, when does the tax consequences, when do they actually take place on the tax return? The fourth question is who has to record the various tax consequences? And the fifth is characterization. So here, we're really focusing on the question is, what are the tax consequences with respect to President Papaya? So you might be looking at this and saying, well, I don't see any inflows. Where exactly are the inflows at? You might be thinking, well, President Papaya hasn't died, so there's no payment on the insurance. And generally speaking, you're correct to think that. But what we're looking at here is the actual cost of the life insurance. So the premium is paid. The premium's paid by the employer. The premium's paid by Crazy Coconut Corporation. Because think about it. If you actually had life insurance on your own life and your employer did not provide that, what would you have to do? You would have to contact an insurance company, you would have to go through a policy, and you would have to pay premiums during the year for that policy coverage. Crazy Coconut here is paying that policy coverage. And that policy coverage is $12 per year per $1,000 of coverage. So we're saying here that, let's say an employee makes $100,000 a year. Well, the corporation is paying is providing coverage for up to 2 times, or not up to, for 2 times the salary. So $100,000 would be coverage on $200,000. So that means that for that $200,000, it's $12 per 1,000. So it's every 1,000. So that means you would take that $12 and you would multiply it by 200, because for each $1,000, so 200,000 divided by $1,000 is $200,000 of coverage. Now this is an example of a fringe benefit. A fringe benefit. And really a fringe benefit is when an employer provides something beyond just compensation. So examples of fringe benefits include health insurance, dependent care, a gym on the premises, or some type of health plan program, transportation perks, various perks provided by the employer. And there's so many of those out there. Frequent flyer miles even, use of certain items on the facility. Again, I mentioned gyms. There's other things that might be available at the facility. You know, think about Google, and they have like this cafeteria for their employees and whatnot. It's this crazy nice cafeteria, right? All those different things. Those are fringe benefits. And the taxation of fringe benefits, there's some interesting rules on that. And a lot of fringe benefits actually get excluded from gross income, just so you know. Now, life insurance has special rules. Life insurance is the first fringe benefit that we're specifically dealing with. Life insurance coverage, the actual cost of the premiums that an employer may pay on behalf of the employee, has special coverage. Now, if you think about our definition of gross income, okay, if you think about, generally speaking, whether we have gross income or not, well, remember that under Code Section 61, gross income is defined broadly. It's income from whatever source derived. Income from whatever source derived. And remember from the Glenshaw-Glass decision, there's 3 items that make up gross income. The taxpayer must have an accession to wealth, which means that net worth has gone up, clearly realized, and there must be dominion and complete dominion and control. Well, here, when an employer provides coverage for you and you get to designate the beneficiary, you have all 3 of those because the cost of the premiums can be viewed as net worth going up. Okay, if it's either viewed as an asset or you can view it as a liability, because if you wanted to provide coverage on yourself, well, guess what? You would have to go ahead and make that payment. So it's almost like it's an extinguishment of some type of obligation, like a liability that would have had to be paid. And then realization, well, fringe benefits come from services worked at this corporation as an employee. So therefore, services equals severance. So we have realization. And finally, dominion and control. Does the employee able to do what he or she sees fit with this item? Yes. The employee designates his or her beneficiary. So this is gross income. This is gross income. So you would think that the $12 per year per thousand would be included in gross income. However, there's a special rule. The special rule says that if certain criteria are met, then there's actually an exclusion. There's actually an exclusion of up to $50,000 in coverage. Up to $50,000 in coverage. So it would be the $12, not $50,000. Up to $50,000 of coverage. And again, remember, we're dealing with the premiums here. We're not dealing with, okay, well, the employee dies and now the payment takes place. There's actually a provision that deals with life insurance payments that we're going to talk about later on when we talk about exclusions. This is basically a partial inclusion rule. It's partially included. Yes, it's included, but you're going to see there's going to be a partial exclusion as well. So you're allowed to exclude, if certain criteria are met, you're allowed to exclude $50,000 of coverage. The premiums on $50,000 of coverage, so the premiums on that, plus any premiums paid by the employee. So sometimes employers pay a certain portion and the employee covers the rest. Or maybe, okay, 50% covered by the employee, 50% covered by the employer. Well, the portion paid by the employee is excluded. It's not taxable to the employee. It's not taxable to the employee. That would make no sense. We just talked about annuities and how the recovery of capital concept, it's a similar idea. Why would you be taxed on the portion that you actually paid on the premiums? Okay, this is dealing with the employer's portion. The employer's portion. So you get to exclude up to $50,000 of coverage, the premiums on that, right? So here, that would be 12 times 50. So it's 50,000 divided by 1,000 per 1,000 is 12. So it'd be $600 of exclusion in this example. Plus any premiums paid by the employee, which in our example, no premiums are going to be paid by Papaya. The corporation's paying all that stuff. Now that's only if certain criteria are met. So in order for this exclusion to take place, okay, the recipient must be an employee. Must be an employee of the corporation. And do we have that here? Yes. President Papaya is an employee. The next requirement is that the benefit be in the form of group term life insurance. It must be group term life insurance. So group term life insurance deals with a group of employees, specific plan, and we have that here because the Crazy Coconut Corporation carries group term life insurance on each executive and many of its employees. So we have that. Next, and the third requirement is that the insurance be paid for by the employer. So the costs, the premiums are paid for by the employer. Premiums paid by the employer. By the employer. And do we have that here? Yes, we do. So it looks like exclusion is going to apply here. It looks like exclusion is going to apply here. Now, there is a limitation on this, and this is called the discrimination rule. So the discrimination rule says if certain employees of the corporation or the employer are the only ones that get this benefit, then they're not going to be able to get the exclusion. They're going to have to include the amounts. So this is basically to say, okay, well, sometimes companies will provide life insurance on their executives or high-level employees, but not all employees. Well, here we're told that executives get it and many of its employees. So this could go either way. If it's viewed as this is discriminatory, then guess what? You would not get the exclusion. President Papaya would not get the exclusion and would have to include all of the premiums for the year. But if the discrimination policy, if it's not viewed as discriminatory, and that seems like it is here because many of its employees and executives, then the exclusion does apply. So that's very important to understand. And there's specific rules on what exactly a discriminatory policy is. I'm not going to go into those, but you just need to understand in general. If you see some type of issue where it's only on the executives of the company and no employees, or it's only on the top, like the CEO, the COO, the president, then it's automatically discriminatory. But if it's available to most of the employees of the corporation or the business, or it's provided to most of the employees of the business, then it's not discriminatory. Doesn't have to be, for all employees, has to be for a good portion. And again, there's special rules on that. So we're going to go ahead and we're going to say that it is this is not discriminatory, so it does apply. All right, so it does apply. So now what we have to do is we have to calculate the actual amount of the exclusion. We have to calculate the actual amount of the exclusion. All right, so again, we're able to exclude up to $50,000 of coverage plus any premiums paid by the employee. Again, President Papaya here is not paying any. The Crazy Coconut Corporation is paying all of it. And again, we're addressing the who question here is President Papaya. What portion does President Papaya have to include? So what we do here is we start by looking at the salary. The salary of President Papaya is $200,000. $200,000. And we're told that Crazy Coconut Corporation has life insurance coverage equal to 2 times annual salary. So we multiply that $200,000 times 2, and we get $400,000. We get $400,000. So that's the amount of the life insurance policy carried during the year on President Papaya. So that is the amount. So we subtract from that the $50,000 that's allowed for exclusion, $50,000, and we get $350,000. $350,000. That's the portion. So the $50,000 again, that's the portion that's excluded, not $50,000, the portion of the coverage. So again, the issue here is what portion of the premiums is included. So what we do is we have to get that number. So again, the cost is $12 per year per thousand. So we take the $350,000, which is the portion that is the coverage portion on the premiums that is taxable. We divide that by 1,000 again because it's per $1,000, which gives us $350,000. $350,000 times 12 is $4,200. So this is the cost of the premiums. The $12 per thousand on the $350,000 that is included. The $4,200. The $4,200 amount. This is included in gross income. So President Papaya. So the who question is President Papaya during the tax year has to include $4,200 of gross income from this. And you notice that again, $50,000 or $600 is excluded from gross income. So again, the answer here is $4,200 included in gross income. Included in gross income. And again, the idea here is it's the cost of the life insurance. The cost of the life insurance. So now that we know the end tax result here with respect to this transaction and based on what we went through, where President Papaya has to include $4,200 in gross income, which is the cost of the premiums that's included during the year, I want to talk about a few things. Now, there's a few exceptions to this rule. And the exceptions, and this is just important to know, is that, looking at the same rules that we just talked about, just a few things that what if, what if this, what if that, all right? So first thing I want to note is that if the employer was the beneficiary, so if Crazy Coconut was the beneficiary, then President Papaya would not have to include any of this. And that makes sense. That makes sense because President Papaya would not get any benefits. And a lot of times this does happen. In some smaller businesses, the business will have a life insurance policy on the employees and a lot of the executives, and the beneficiary is the corporation itself. So if the employer is a beneficiary, then it's not taxable to the employee. Another thing is if the beneficiary is a qualified charity, then it will not be taxable as well. It will not be taxable as well. So if a beneficiary is a qualified charity, it's not taxable. Not taxable. So those are just some important things I wanted to mention. One final thing is that what would be the tax consequences here if President Papaya had to pay on all the coverage? On all coverage. So like if it was discriminatory or one of these things weren't met where you get to, it's where it's able to get the $50,000 of exclusion. Well, let's say it was not discriminatory. So this is assuming, let's say it is discriminatory. Sorry. So this is assuming it's not discriminatory. And that was our example earlier because we assumed that. So that was not discriminatory. If it's discriminatory, then there is no $50,000 of exclusion that's allowed. And President Papaya has to include the coverage on the full $400,000. So we take $400,000 and we divide that by 1,000, and that gives us $400. We multiply that by 12 because it's $12 per year for coverage, and that gives us $4,800. So $4,800 would have to be included in gross income, and that's if this special rule, this special $50,000 provision, did not apply. So you see, it's really a $600 difference, which is really the $50,000. So if this special rule of $50,000 does apply, which is what we went through from the beginning, President Papaya has to include $4,200. If the $50,000 does not take place here, the special rule does not apply, the $50,000 benefit is not given, then President Papaya has to include $4,800, which is the full cost of all coverage, of the full coverage. All right. Now, one thing I want to know is, $50,000 seems kind of on the lower end. Well, again, remember, this is meant to be non-discriminatory. It's meant to apply non-discriminatory. So it's meant to cover all different areas of employees at a business. So not only, executives that are making millions of dollars, but also lower level employees that might be making closer to $50,000. This is really meant to be more of a small business type benefit, if you will. It's meant to be more towards the small, the lower type, the lower end employees. All right. So I hope that this helps you understand this special rule. Again, this is the special rule here is the $50,000 portion of exclusion.